Greetings, this is Dr. Jeffrey Scott, and this is my pre-market stock market update for Sunday, July 24th, 2022. I titled this was the bear market rally just snapped. Snap earnings came out after market hours on Thursday, showed weakness in advertising, which seemed to spread throughout social media and taking down stocks like Google and Meta significantly. They have earnings this week, so it'll be very interesting to see whether or not this is something that is snap related or broad based. Emails hgsidoc@gmail.com. If you're new to this on YouTube, hit the subscribe and the alarm so you'll get notified when I post these. And I always welcome comments, remarks so I can make these better. Thumbs up, thumbs down, etc. Okay. Disclaimer, this is for education purposes only. Anything it recommends in the spirit of education should not be considered investment advice. I am a doctor, not a broker. The tools demonstrated are those that I use in my daily trading. I pay for those tools. Trading involves risk. You alone are solely responsible for any investment decisions you make. If you're about to take trades, you should always have a very good understanding of your money management and discuss what you do with your financial advisors. Since this is what I call Earnings Palooza week, I'm going to bring back something that was on older slides, which is it is a judgment call to hold stocks over earnings dates. It's bad judgment to not know when your stock's earnings date is scheduled. On that note, let's move into and take a look at the markets. So close that out, save that, and let's bring up the spreadsheet. So I cut and paste from HDSI, EdgeRater, TC2000, and then the internet, some of the programs that I use in addition to wealth charts. And I use this to shorten the presentation some. So on the top, we have the major market indexes ranked by current interval from 52-week high. And you could see that Bitcoin is the leader to the downside, minus 73, dollars flat, or right off its 52-week high. And if we look at things like the NYSE down minus 15, the spiders are down 17, the NASDAQ and the Russell are down 26, the Dow is down 13. You could see that small caps and technology have led to the downside. The Qs, for example, down 31%. Excuse me, the biotech down 31%. And then if you go a little further, FANG is down 34, but that's a leveraged ETF. And the IBD 50 ETF, which is not leveraged, is down 49%. So it's been a rough go. And if you look back when these 52-week highs were set, many of them were set in 2021. If you look back here, you could see over the 5-day period, natural gas had a huge rebound of 16.7%. The major indices were up 2 to 3.5%. FANG and ARC Innovation were up considerably, and Bitcoin had a nice rally. If you look at one day, which would be Friday results, you could see natural gas, gold, VIX, and bonds, and the rest was kind of weak in response to, I think, snap earnings and continued economic fears. If we look at sectors, healthcare is leading the way, only 10% or so off its 52-week high. Communications is leading the way to the downside, down 35%. If we look at the markets last week, and this is a Q Edge tool, which is a great tool real time to get a sense of what's going on inside the markets. Couple things here. We'll start up with these. On Friday, 73% of the sectors were negative, 77% of the industry groups, and 69% of the stocks. So that was a relatively tough day. The things showing positive on Friday, utilities and staples, are what you'd expect to see in a defensive posture in a tough market. Interestingly, if you look at the buckets, 80% of the stocks were above the midline, the Bollinger Bands. I'm going to come back to this in an EdgeRater tool. But the interesting thing is the number of stocks above, which was in the mid-20s, which is very high, came off a lot, down to 11%. So perhaps Friday was more than just snap. It was some profit taking after some big runs up. If you look at 5 days, the markets were super strong over the last 5 days. If you look at over the 10 days in the last month, they were strong. Just the last couple days, again, profit taking and maybe some response to snap and potentially some concerns about what could happen this week with the Fed. The warehouse report shows kind of a flat 2-3% gain across the market on the week. In fact, when you look at performance versus EPS rank, relative strength rate, group rank, there really was no pattern here. So this was a pretty much rising tide raises all market this week. Although, as I said earlier, as I'll say again, it did give up some at the end. Now, this is the NASDAQ, and this is just a chart that I keep up on a daily basis, looking at things like the Hindenburg Omen. And I can tell you that I could have gone back to November on this, and you would have seen a weekly bongo, my trending indicator, and kind of a buy-sell filter, turn green for the first time since November on July 22nd. Now, that's interesting because it's the first time in all these little bear market rallies we've had in this sell-off where it was enough to flip. Now, of course, on the same day, we got a Phoenix, which is sort of a bearish signal as the markets gave up some on Friday. And the weekly is only going to officially change on Friday because the weekly isn't done until the last day of the week. So that's interesting. We still have a problem with the absence of buyers and new highs, although the percentage of new lows has dropped down pretty low. So if you look at the NASDAQ, you can see how far it's flown. Here is where we started seeing that red weekly bongo back in November. A lot of blue and green popped up in the last several days, but we gave back some on Friday. We're now 12% off the lows, and you can see it was a pretty big week. So over the last 36 trading days, the NASDAQ has been up 12%. That's a pretty decent rally. The NYSE, interestingly, did not flip their bongo. They have absence of new highs and new lows, which is clearly improved. And you could see it's 5.7% off the low, but the low was 8 days ago. So nothing here to really get that excited. The buckets clearly show here on EdgeRater, using a different list of the S&P 1500, 79% of the stocks are above the midline, and you could see the number of stocks that were above the Bollinger Bands have come down. This is still pretty bullish looking, although it's a less overheated than it was. And you could see a week earlier, more of a bell-shaped curve, and then this is what bad looked like, 96% below the midline if you go back to when this run started, but this is back June 17th. Energy on the week, if we look at weekly, the big mover was natural gas. UK gas was up 55%. Crude was relatively flat on the week. If we look at the day that was Friday, you could see oil was low, was down. Energy, natural gas was up a lot, as was gasoline. UK gas, TTF gas. And it's kind of interesting because Russians said they were going to start pumping gas to Europe again, which you would think would ease gas prices. And then, of course, like the next day they said, oh, but we're not pumping a lot because we've got some issues with the equipment. Metals. Is gold starting to make a run? Still early, it's down on the month, but it was up 1% on the week. Silver was relatively flat. Copper picked up some as well as iron ore did on the week. And these have been very weak, and you can see the monthly on silver, copper, steel, iron ore all down 10%, HRC steel down 18%. So it'll be interesting to see if we see improvement with this. The dollar probably being the big culprit, but the dollar has come down some. Now, this is the Baltic Dry Index, stocks like Starbulk Shippers, which actually popped some early in the week. Zim and others are very much tied to the spot price on the container ships. And you could see why those stocks have come down over the last couple of months, because this average has gone from 3,400 to 2,150. But it looks like it might be starting to wake up, and perhaps it's holding at this support level. Interest rates came down considerably despite talking up rates by the Fed. And perhaps the interesting, this is the 10 year, and then the 30-year. The white is the interest rates, the yellow is the spiders. If you look at the 210 inversion, we're really way below. I don't know, boy, that's scary. And I guess it's perhaps it's concerns about, that we're already in a recession. Um, but that just gives a sense of how much fear there is about economic slowdown. Now, and the good news is the credit risk came down some, but it's still very elevated, even above what we saw in the end of 2018. And as I like to point out, this is what happened at the end of 2018. The market rolled over. Overbought, oversold, stocks above the 200 increased, stocks above the 40, a shorter term thing, really increased a lot, and the 12-week new high, new low increased. So nothing that's an extreme on either, with improvement on the longer term ones. Economic news, this is a doozy. Case-Shiller, consumer confidence on Tuesday, how are the consumer doing? Durable goods, capital equipment, oh yeah, Fed meeting with target rate and a Jerome Powell press conference on Wednesday. Thursday, we got some GDP release. We're expecting a 0.3%, but if it's negative, that would be 2 quarters in a row, and I think that makes it a recession. If we look at jobless claims, you could see we've got those on Thursday and continuing jobless claims. We're starting to see jobless claims go up, and lots of high-profile companies are making announcements that they're slowing hiring. And then on Friday, we got a bunch of inflation data and a PMI. So that's a doozy. Earnings, oh yeah. Remember I said earnings Lollapalooza? There's something here for everybody. Is it energy stocks? You still got Range Resources. Is it gold with Newmont Mining? Is it UPS, Coke, Google, Microsoft, Visa, Chipotle, McDonald's? What a day on Tuesday. Wednesday, Boeing, Ford, Meta. See if they have the same issue, Alphabet Meta, as Snap did. Tech, which I'm no longer in. And then on Thursday, will Tilray give us some good news about marijuana? Pfizer, Amazon, what a week. So that's why I made the comment about you need to know when your earnings dates are, because this is a giant week of earnings. Expected moves, I'm sort of giving up now on this because it's just not behaving. 80% of the time or so, stocks are supposed to stay within the expected move. The expected move is a straddle at the money, buying a call, buying a put. You need a big move to make money on that trade. The market makers sell you that spread, and as long as you stay between the red and the green, they make money. If you look at the S&P, it moved right up this week, took out the top and came back and closed at the green, so that would be a tie. If you look at the NASDAQ, it too broke out. Here's Monday, didn't do much. Tuesday, a massive day. Wednesday got above, Thursday further above, and just when it looked like the market makers might lose a lot, Friday it came back in, still closed above the green, but not a big loss for the market makers. Russell, same thing, closed outside just above the green. Excuse me, that's the diamond. The Russell, like I said, same thing, closed above the green. And the VIX and the dollar stayed within their range. So still a lot of volatility in this market. So what are my thoughts? Again, the major indices finished higher in the week as the market started the week strong but sold off a bit into the close. Major news week, one of the biggest for earnings, hard to handicap as we look at a week with consumer sentiment, GDP, inflation, Fed meeting, and oh yeah, 75 basis point raise. Speaking of earnings, something for everyone, big cap leading what I refer to as earnings Lollapalooza. And the ironic thing is the Chicago Lollapalooza festival starts on Thursday, the same day as Amazon earnings, which used to mean a lot to me. It used to be my largest holding. For the bulls, the weekly bongo on the Qs and the IWM closing green for the first time since November is interesting. and suggests that perhaps this rally might be different than the last dead cat bounces, which we've had many of those. Adding to this is the fact that each of the daily major index ETF charts closed above their 50-day SMA, which had been prior resistance. So that's kind of a bullish tint, but you have to get through a lot of news and earnings for that to stick around. Of interest, the spider and the diamonds. Before the weekly bar closed, they were also trending towards green on the weekly bongo, but the sell-off on Friday eliminated that. So whether you're a bull or a bear, I think the big movers will come from news flow, economic data, Fed commentary, rate hikes, or earnings. And this is a week to be careful. I do have some positions because the markets earn them, but I am still sitting on a lot of cash. And lastly, if you like this video, I refer you to my stocksanddocs.com site. I do a free video there almost every day. Didn't do one on Friday because it was my anniversary Thursday night, and I just didn't get around to it. But I hope you go and check that out. There's no cost, and I think there's a little thing you fill up for a mailing list and you get notification when they're posted. I usually do those late at night or early in the morning, and then the team posts it for me before or around the time the markets open. So it takes care of that. Now let's go into wealth charts and see what I'm seeing in the market. So this is spiders, Qs, diamonds, and Russell, VIX, and dollar. So the yellow is the 50-day moving average. This was trendline resistance, which we broke above. Then we broke above the 50. The yellow line is the June lows, which is sort of my short-term support. A break below that puts the January or February 2020 highs in play, and a break below that starts to make us think about the March low. I don't think we're ever going to see that. My hope is that this June low holds, but I think that's hopium right now, and I have to be open-minded that we're still likely to break down below that. Where is my target from here if we keep going higher? Wouldn't it be nice to take out these prior highs, which would be about 417, and then maybe if you break through those, get up towards the 430 range of the 200-day moving average on the spiders. What I like about this is, yes, Friday was a tough day in the market, but we did not break below that 50. Qs, down day, just like on the spiders, holding above the 50. Same thing with the diamonds. The Russell also. Now, if the market was about to roll over, don't you think the VIX would have done something? And yeah, the VIX was up a little bit less than 1% on Friday, but really, it really didn't do anything. And then you look at the dollar, which is weakening, which I think is actually bullish for the market. The commodities, I mentioned gold was up a little bit on Friday, but if you look at that candle, that's not a bullish candle. That is a bit of a shooting star and not very, doesn't make me feel warm and fuzzy. Silver did nothing. Energy dropped down hard. This is oil. Now it's bouncing around, maybe consolidating for a while between the 50 and the 200. UNG, natural gas. Boy, this is a V bottom. Massive pullback. Failed at the 50, which we call an ISO failure. Pulled back to the 200 and has had a massive bounce. And then, interestingly, in the face of a EU, a rate increase, and a likely Fed increase, the 10-year actually came down. Now, last week at the Wealth 365 event, I talked about a simple timing model that I use, which looks at price on a weekly chart compared to a 30 WMA or SMA. The white is the W, the yellow is the SMA. And that all clear to me would be when we get back above that WMA, say, so, and my weekly bongos turn green. If you look at the spider, we're way below, we're red here, so that is still a weak market. The Qs getting close to that 30 week, and their bongo turned green, so that's a little bit interesting, similar with the IWM, and the Russell has not turned green. For me to be really comfortable that this market has changed, I'd like to see it get above the moving averages, and you could see on the way up how these things act as support. And when the bongo turns red and you break below, it's not a good time to be a bull. Another thing that I look at on a market timing basis is this multiple moving average. Just because it looks like this market may want to go higher, what this tells me is we've got a lot of resistance above with these moving averages to get through. And so I'm not by any means saying that this market has repaired itself and is definitely going higher. I am saying the market has improved, hence my comment that it earned a little bit more of my money off the sidelines, but I still think we're going lower if I had to push came to shove. Market theme, although we had a hint on the short term that we were going down towards small cap, so large cap upper right, small cap lower right, we reverted back up, started pointing back to large caps as the week ended. So the small cap, this is on the longer term, we did pull back off the highs here, meaning favoring small caps, but we bounced on Friday, which would favor the large caps. And over here on the growth upper right, value lower right, value's definitely been in charge, but we're starting to see some evidence of growth, but it didn't really end that week, way on the week, as you see the red there. I like to look at ratio charts to get a sense of what's working in the market. Now, mind you, I'm not sure anything was working at the end of the day Friday. It was a tough market, and that's going to skew a lot of the stock charts because you're going to see a lot of good charts with a lousy Friday. But I call my star candidates the things that are leading, and when I look at the individual S&P sectors in a ratio chart versus the SPY, technology has really picked up a lot. And let me tell you, that's a really good thing for the market. You want leadership from technology. Now, is it out of the woods? No, it had a rough Friday, but technology is pointing up to the upper right-hand corner and leading. And then the other thing that looked interesting was consumer discretionary, the XLY. And we'll see what happens this week with Shopify, Amazon, and others reporting. Communications was hinting, but with the Snap debacle, it came down hard. Really don't see a lot of excitement in materials and energy despite natural gas. And then the defensive plays picked up on Friday, staples, real estate, and utilities, but they're still in the lower half of the charts. And then I guess the third, if I had to give another star candidate, would probably be healthcare, just a little bit more exciting looking than staples. Now what's interesting, if I put that same market timing model on the sectors, so this is no longer ratio charts, these are weekly of the S&P sectors. And if you just look down at the bongos, you can see the only green are on the two on the right, technology and discretionary. Before I go into the scanners and take a look at individual stocks, if we look at seasonality, I want to call this one out. If we look, we've been in a very strong seasonal time of the market, and there's still some strength. If you look at over the period from now to the end of August, and you're looking at somewhere the dates will be here, July 26th to August 30th. And the reason why it's the 26th was the Monday last year was the 26th. That over the last 10 years, it's been up 8 out of 10 years, average return at 2.6, maximum of 16. But when I look over here and I'm looking at SPY sectors over 4 weeks, it's kind of flat on the winners, utilities leading, technology 0.76, healthcare 0.36. But when I flip to bearish, energy minus 2.5, discretionary, materials, and the spider over the next 4 weeks is relatively flat. So seasonality has changed some. And so let's go take a look at, I want to show you one other thing, which is the S&P 500 sectors. Now I'm looking at monthly. And if you look at this chart, you should get a sense of over long term where leadership has come from. And the reason why I think it's so important for technology to turn around is technology is really the long-term leader in the market. And if we're going to go higher, I think technology is going to take us there. I think discretionary and healthcare are also things that will take us there. So when I see the market rotating into technology, it does make me a little bit excited. Now, there's something not working right with the CAT scanner, so I'm going to have to ignore the bongos on the scanner. Um, the guys at Wealth Charts pushed out this awesome update. Let me just tell you how awesome the update is going to be. Um, on my filter, we're going to be able to scan how many days ago the bongos turned. So we can look at a green bongo weekly and a turn to a green bongo daily within the last couple of days to find a pullback in an uptrend. Um, we're looking now at how many days ago the squeeze ended. I talked about it well chart, so I now have this thing called a squeeze release that shows up for 3 days after you come out of a squeeze. So there's a lot of cool things they did, but I don't. I've been having challenges with the bongo, which I think we just have to go and look at what we did in the code. So that'll be fixed sometime this week. If we're participating in the Well 365 event, you know that Rob and Ted were there every day until 10 o'clock East Coast. They started their days at 6:30. So they pushed it out. Ted's on vacation, and he should be back, I think, early in the week, and we'll get the bongos fixed. But the thing that I do spend my time on really is looking at the dots, and the dots are working fine. So if I look at the weekend review, which I did is I took the leading stocks from the leading industry groups, also married them to a bunch of other scans I do, and I look at what comes to the top, you're going to see a lot of my comments about Friday. Hanger. This, I don't know if this is a buyout. It certainly looks like a buyout. Went from 14 up to 18. Now, we could check news and look this up. If this is a buyout, I would leave it alone. But if this turns out to be a big gap up on earnings, I believe this is a healthcare stock. Um, a breakout above all the moving averages on massive volume, gap up, volume, breakout, bongo, squeeze, release, massive improvement in relative strength and OBV. That's amazing, but it looks to me like it's a takeout, so I would look into that. Healthcare facilities also looked really good. I think there must have been some Medicare reimbursement rates that came out because across the board you saw big gap ups. This is HCA, one of the leaders. Don't like that it closed at the bottom of the day, but considering that Friday was a weekday in the market, you had a gap up and you had volume gap and you had momentum on this. So this is interesting. Lots of overhead supply. ACHC is another stock in the same sector. It's a little different. I think it's nursing homes, rehab hospitals, but breaking out. Now, why would the Fed rates matter? Well, as a physician, every year they come up with a physician fee schedule, and my income could have gone up 1, 2, 3, 4, 5% or down that much. If I'm a hospital system doing billions of dollars of revenue per year, and they do something that increases it by 2 or 3%, it's a lot of money. If they take it down, it's a lot of money. If it's a favorable fee schedule, then they trade up, and I think that's what happened here. ACHC looks interesting. Why? Because it's already taken out its recent highs, and there's kind of clear territory, no overhead supply. So this is one that looked interesting in that group. Um, Then you get a bunch of utilities. Now, the utilities are interesting. They pay a dividend. Defensive for sure. Here's a stock, Nextera, which I believe owns our FPL down here. Nextera has to get above the 200 to be interesting, but you've had a big volume breakout momentum from a squeeze, relative strength at OBV looking good. And when I start to see Nextera, we had a couple of them here. Eversource, chart's too far in the pattern, but it did get a couple of the impulses. Nextera here, NEE. So when I start to see multiple, that's interesting, Nextera there. Oh, okay, one's a limited partnership. When I start to see those PPG, when I start to see these things moving, um, that is defensive. They're dividend plays, but that's kind of starting to look like a wolf pack of similar stocks. And all I've done is I've ranked my weekend review by bullish signals. And then one of my favorite charts of the weekend was AMT, which pays a 2.1% dividend. And why did I like it? Because it looks like it's breaking out of a wedge. So we could come on in here and go to line, do a trend line. Let's take this up here, bring it down to that, the prior high before the most recent low. Yep, and let's go down here and let's draw another trend line. And let's take that one, say, whoops, something like that. And are we breaking out of this wedge? And we are with volume, excuse me, with the breakout in momentum. Bongos have turned green, relative strength, and OBV heading in the right direction. That one looks interesting. Now, the problem with this and so many of the stocks, and I talked about it at the Wealth Charts event, is the overhead supply. So I wish I could show you something that is awesome and ready to go and I want to buy it. Um, this is a week of a lot of stocks that are pullbacks. Now, American Express had a great earnings report. Maybe it's the right thing to buy American Express, but it's already run from 149. Well, I guess it's only run up because it came back down to 152. But this is one you might consider coming out of a squeeze. Now, you had some good information here with a breakout in momentum, came out of the squeeze, gapped up here, and look at the relative strength in OBV. So AXP is another one that looked good. Now, Change Healthcare I thought looked attractive, but this one is in a takeout with Optum. And I think the movement we're seeing in the stock is sort of the handicapping of whether a deal gets done or not. So I'm not an arbitrage player. Same thing with Covetrus, which is right here. And when you see this, this is clearly a takeout. And if I go back to Hanger, which may just be because it's in the healthcare facility business, like the others, but that looks like what you same thing you see in a takeout. Health Catalyst is a company that is in a similar space as my company. It's a healthcare technology and data company, as is Change Healthcare. And this one looked interesting as well. But you're talking about a stock that is way down in the pattern, and you'd expect to see some overhead supply. Um, you look at some of the commonly held stocks. Let's look at Apple. It has earnings this week, I believe, on Thursday. What a beautiful run Apple's in the midst of, despite this being a bear market. Daily and weekly are good, and this would have been a nice time to be looking at it down in here. But it's had a big run. I have a hard time buying this before earnings. Amazon. I have a small position in Amazon that I entered a few days ago, and I entered it because of the breakout here. 17 crossed above the 50, but Amazon is a little bit above support now. I think you got to wait and take a look at earnings unless you think you know something. Now that's a bearish engulfing bar as well on Friday, which is not a bullish thing, but I think earnings, we have to see where earnings are before we get excited one way or the other. Microsoft also has earnings as part of Earnings Lollapalooza. And when I look at Microsoft, it came right back into the pattern. Breakout above 268 might be interesting, but right now it's just still stuck in this choppiness. What else? Google. I think you're going to see the same thing I'm going to show you with Meta. Alphabet just got hammered and didn't recover. It opened down quite a bit and continued lower. If anything, this looks more like a short to me. Look at relative strength and OBV breaking down, but it's got earnings. All they have to say is, hey, we didn't see what Snap saw, and Google will be fine. And Meta is another one. Meta Platforms, and you can see that Meta And as I said, it broke down here. Meta was starting to look interesting, breaking above the 50. Look at this move right here. You had an EMS signal. You had volume breakout momentum as you came out of the squeeze with relative strength and OBV looking good. And then this is what happened. SNAP, Snap, and Snap did this again. And if you went back to the last earnings period of time, which would have been 3 months ago, I think this was the last time that they did that. Seems too quick. But the same thing happened as it just happened again. No, it's probably that. Bad earnings, blame it on advertisers, and a lot of it has to do with how Apple changed their algorithms. Now, I can also go to a bear market scanner and let me go into my filters. I've set a higher price if I'm going to short something, and I want some option liquidity, and I just want to hit the bearish dots. That's all we should get. And let's rank the dots. AMN, this has been a leader. This one got clobbered on Friday. Is this profit taking? The stock has run from 82 up to 120. That's a 50% per move. And then it backed down to 110. This could be just profit taking. Perhaps the Medicare fee schedule is less friendly to them. DGX, Quest Diagnostics. This is one that, when I look at AMN, I probably would have been stopped out, but you've got the 200-day right here. I don't think I'd be shorting this one here. Quest Diagnostics, and shorting is risky, and this is just me talking and not investment advice. I failed at the 50 and the 17. My relative strength and my OBV have turned down. I had high volume, a breakdown, and momentum from a squeeze. If I was looking for things to play the downside, that one looks like it wants to go lower. GameStop had a split, so this is a split. I don't pay attention to it. It will be fixed. Gentex. So the same thing that helps me find bullish plays also helps me find bearish plays. Again, failure at the 50, run up, breakdown. This is one on huge volume. Again, volume, breakdown, momentum, out of a squeeze. Look at relative strength and OBV. Another one that if you were looking for something to play to the downside, we already looked at Google. So this is what I do. I basically start with the markets. I could have gone into the wealth scanner, which will be right here. And the wealth scanner would have showed me on the bullish side not much. It would have shown me ARC Genomic, Biotech. Now, but what I noticed, these numbers are in the 4s, no longer 8. They both weakened considerably. ARC Genomic, look at what it did on Friday. Biotech, same thing. Now, they can come back, and they certainly don't look like things that I'd be going out of Dodge, shorting, etc. Construction is a surprise to me, but you had good earnings from DHR, Horton, and also Lennar. So that's one that's moving up. So maybe I might want to look at housing stocks. So I could type in Toll Brothers. Looks just like ITB. How about DH Horton? DHI, I wanted to get it down here. Nope, wrong one, wrong one, DHI. Also a gap up. So these are stocks that were totally beat up, but they surprised. And then Fidelity, Magellan, bonds. There's nothing here that lights my heart on fire. In fact, if I go to CAT scanner and I look, this is the bullish scanner, and I find healthcare, and this is the bearish one, of course. Let me go to the bullish one. My bad, bull scanners. Let's go to healthcare. We are just about done. and we look to see what came to the top. There's Hanger, the ACHC, HCA, Encompass Health. They also own facilities. Tenant owns facilities. Wolfpack, their UHS owns facilities. So you saw a big move in providers of facilities in healthcare. So I think I've covered what I wanted to cover. Let me just end with contra ETFs. If the markets are going down and you don't like to short, and again, I am not giving investment advice, please consult your financial advisors. But there are things that go up when the market goes down. Now the market was up, so SDS goes up when the S&P 500 goes down. It's pulled back with the S&P showing some life. The SQQQ will go up when the Q is going down. Now it's pulled back as well. Now the funny thing is, I like to buy pullbacks in an uptrend off of support. All right. Here is the dog. It will come down when the Dow goes up. Here's TZA. It will come down when small caps go up. Notice that most of them have green bongos on the weekly. TZA just flipped. The message here is simple. These are not things you want to be holding. You never really want to buy and hold these. But if this market rally is failing, if the Fed and earnings and news cause this market to roll over hard, and if we start to go back and visit the yellow and break that yellow line, you're probably going to be you have an opportunity to have some gains on the contra ETFs. If these head up higher, you don't want to be touching them. Hope I didn't ramble too much. I love the tools. I love wealth charts. And we'll have that scanner up and going. Ted and Rob have just done amazing things with what I've asked. Every time you make a change, you need to review it and course correct. This happens, and we'll do that this week. So those that have it, don't lose faith. What you're going to get is going to be even better. Have a wonderful Sunday.